I have not seen Jason. I sent him an email.
Okay, let me try to chase him down. And
I'm here.
Oh, you are there.
Oh, you are there.
Great.
Fantastic.
Yeah,
Jason.
hey guys.
Okay, great. So, David, why don't you take over and you can introduce the group? We'll go from there.
Okay, thank you very much, everybody. Thank you, Marty, for the invitation and for me, the lovely events you host here in Austin. This is the fourth event that I've been part of with Marty. It's always been insightful and inspiring for me. I absolutely would agree with him that Austin, Texas is a hot and happening place. I think he listed 4 or 5 of the companies coming in. There are actually 30 or so tech companies moving in real estate projects and invention or corporate leadership campuses. Pretty much any piece of Silicon Valley that you think of, there's a branch of it here. I think we're cheaper and vibrant and easier to travel in than the West Coast. So I'm David Nayer. I have been in the innovation and technology construction space, I guess if we want to summarize it, for 40 years. I came to Austin to run business development for Dell in the mid-90s. I've been part of 31 ventures in some form of principal contributor or founder, and 780 or so inventions. The number's a little vague. I have a background originally in mathematics and then in applied mathematics statistics and what became known as AI, but we called it pattern recognition. I also have an MBA from Kellogg, so I'm trained in finance and marketing, which after my stint in invention became work in market matching, finding homes and use cases for inventions that were fruitful and productive, not just novel. So my current work involves setting up funds that have specific and novel contributions to be made to the venture space, as well as helping deal flow, the valuation of intangible assets, or the construction of joint ventures, which bridge multiple perspectives and multiple opportunities, typically internationally, and need a synthesis across different domains. So my favorite type of work is the integration of different people and different ideas into new markets. I'd like to introduce our panels. I think we're going to go one by one, and I'm simply going to take the order that I see you on my monitor. So Jane, will you please introduce yourself? Spend a few minutes telling us who you are and what kinds of things you work on.
Sure. My name is Jane Andrews, and I'm here in Boerne, Texas, right outside of San Antonio. I've lived in Texas for ever since 2005. I left New Orleans with Katrina, but going way back, I lived in Madison, Wisconsin. I was born and raised there, went through kindergarten, through the undergrad, master's, and PhD program in an area in life science in general. I was in college for a very long time. I think it was 12 to 14 years. And worked in many areas of life science, including what we call, at that time, was the primordial stem cell, that of the pre-implantation embryo, realizing that we could take a single cell from an embryo, put it in another person, and it could grow into a whole new baby. And that's what we call totipotency. And that's really the foundation for this new budding industry of regenerative medicine cell therapy that we see today. So that's how we see things that happened and we were studying years ago come back and become prevalent. Just like David was talking about artificial intelligence and how what he learned in the 80s is now something that's really hot now. So after 12 to 13 years in college, I did an additional 2-year postdoc at Penn State University in membrane biochemistry and biophysics. And then I realized, you know what? I don't want to do science for the sake of science. I don't want to just do it to study. I want it to mean something. I want it to have value to society. And at that time, I became the scientific liaison for the commercialization of intellectual property at Penn State. And I wrote my own business plan, and I got up in front of VCs, and I got 2 VCs interested in funding my company, but they didn't want to give me any equity dilution protection. So I dropped it at that point. I wish I hadn't, but I grew from there. Did a walkabout science and business and became an entrepreneur. I was a consultant in human IVF in LA. I was a senior scientist at the Audubon Center for Research of Endangered Species. I was a NASA scientist for a while, finding real-world applications for satellite technology and public health. And then I became a senior consultant for Frost & Sullivan, traveling internationally, working with anything from large companies like Baxter, Olympus, all the way down to small startups with lab on a chip, wanting to know what market they were going to go into, who was going to fund it, how were they going to get funding. I was dealing with these market interactions. I was helping match companies with the markets and the market opportunities, not only with market analysis, but with partnerships and funding and how to help them commercialize those products. That little lab on a chip had to be commercialized, just like I see today in my role here in my own company called Cellbridge Strategies. I help large companies and small companies meet the markets through helping them develop their technologies, develop strategies, create partnerships, and help them find funding. And how that fits into the family office is very interesting because my perspective may differ very much from a private equity firm or from a family office, in which I try and match the technology with the investor. And it not only involves bridging that gap, there's currently a gap. There's a gap between knowledge and there's a gap in trust between funding agencies and companies, startups and mid-sized companies. The investor oftentimes doesn't understand the science or what that's going to look like when it's commercialized. So these are the kinds of things that I do. I try and match opportunities.
I'm just going to jump in for a second.
Sure.
So lovely. I'm going to ask our panelists, describe who and where you came from, and then we'll come back to the opportunity that you see, so I want you to just hold that. For those of you who may not understand the term self-medicine, this is parts of your own biology reintroduced to yourself in order to stimulate your own healing. Or is that a oversimplification?
It's fairly close.
Maybe just 10 seconds on what self-medicine means.
It's cell therapy. So it's there's 2 types. One is where you take a scientist or a doctor takes cells from yourself, modifies those cells and put them back into you. And that can result in a cure for what was before an incurable disease, like leukemia.
Perfect. We'll just leave it at that. Very interesting area of new medicine. Christian, please introduce yourself.
Thanks, David.
Thank you. Yeah.
So my name is Christian Mack. I'm a family office out of Newport Beach, California. I wasn't always in Newport Beach. I actually started in Chicago. Went to University of Chicago, was a math major, back in the mid to late 90s. Put myself through school by taking on the odd IT job, as I like to kid around because back then in the late 90s, I could spell IT and everyone was worried about Y2K. I instantaneously became a consultant for a couple of years and then started an enterprise software company called Resolve, which started in 1999. Grew successfully throughout 2012, in which case had a successful exit event ultimately to a private equity company called Insight Partners, and took a couple of years off and started a family office. And then in 2014, we decided to start a private equity platform focused in the distressed enterprise software space that we would basically buy assets, take controlling stakes and turn them around. And so that private equity company is called Lotus. So that's a little bit about myself.
Thank you very much. My math studies was also University of Chicago. I think I'm about 15 years earlier than you. Thank you. James, introduce yourself.
Good morning, James Rabikoff. I run an investment bank called Aiken.
Marty, can we make him louder?
Can you hear me? How's that? Does that work?
Go for it.
Yeah, Dave, that's all I can do.
All right.
Okay, you're good. I can hear you.
Okay. I've been around for about 30 years. I founded it with two senior partners at Davis Polk and Wardwell. And we've grown the company over the last 30 years to focus on three disciplines: buy and sell side M&A, which is sort of split between both buy and sell side, financing, institutional equity and debt, and restructuring, which, you know, is cyclical, but maybe now it's more pertinent. Aiken Bay has about 6 verticals that we focus on. We've done about 175 deals over the last 30 years. We try to do somewhere around $400+ million in transaction value a year, depending on, you know, the sort of mix that we do. A lot of the deals we do, we put together financing with our transactions, meaning stapled financing on a lot of our sell side deals. But what we really try to focus on in Aiken Bay is trend analysis and trying to figure out, when we look at deals, where there's a value proposition, where the company is going to go for the next couple of years, and is there really an exit and an appreciation for the investor? And if they don't have those sort of checks in the box, then we're just sort of doing a transaction and not really looking at the value proposition. So when we look at deals, we're like, is this company going to be worth 3 times, 4 times, 10 times, or really nothing, and all we can do is restructure it and deleverage it? And that's, you know, a different type of transaction. So we've been successful in really sort of focusing on deals that get done. We do 6 to 8 deals a year here in New York. They're all national. We do global deals, but mostly in the US these days. And I lived in China for 4 years. I, like Marty, went to Penn and Wharton. But my real strength, I would say, is looking at an investor and a deal and trying to say, this is a really good marriage. Or, you know, something, this is going to require a lot of money. I think that unless you have a lot of capital, this is not the deal for you. So we really try to get in front of investors and sellers to make sure that it's really going to work out. And that has been something where, you know, we've got a name for ourselves in the marketplace. Deal size, typically our mid-sized deals are in the mid-teens of EBITDA. We do look at stuff in high single digits to low 20s. Right now, as we see the market, which is really choppy and very, very shallow as far as deal flow, we're looking at a few deals that are, you know, $7 to $10 million in EBITDA. That will probably continue for a while. And we haven't really focused too much on family offices. We cover about 300 private equity funds, about 50 mezzanine funds. We cover all the major insurance companies, and we cover, you know, 40 money center banks around the world, specifically on our financing side. I think that there's probably some new opportunities as you're looking at the new market for the next 6 months, where family offices could have a little different role than typical private equity. And the question is,
let's come back to that. I'm just going to jump in because we're going to talk about if that works for you.
Yeah, go ahead.
Okay, let's come back to the opportunity. Let's just introduce our next panel. I don't know how to balance the pushy and not pushy in the time of. We'll just do that. Come back, James. Okay.
Sure.
We're going to go in the other. We're going to go back in the other order. So, Jason, are you there?
I am. Thanks for having me here, David and Marty. Appreciate it. Very good. And I appreciate you guys having me. I'm looking forward to learning from Jane and James and Krista on this panel. I will say, you know, I'm looking at myself in the video. I have not had a haircut since the beginning of the pandemic. So I'm trying to kind of channel my inner Don Johnson, Miami Vice, circa 1985 haircut here as we do this. So my wife and 3 kids and I, we live in Austin, Texas. I've been in the industry for 17 years in the investment management and investment banking kind of world. For the last 6 years, I've worked for the late Boone Pickens in all of our investment management kind of affiliated companies. I now, you know, after Boone passed away in September, in February, I officially launched my own boutique investment bank, JT Wallace Investments. And really, while we don't have a sector focus, you know, our deal flow historically has been in direct deals in natural resources, real assets, energy, and large scale industrial and infrastructure project finance. You know, given the extent of our investor network, we also partner on one-off deals with other investment banks and platforms. You know, current examples of those would be working with a large investment bank on $1 billion basic materials acquisition, another smaller bank on a lower middle market campaign for reoccurring revenue in tech, and then a third platform that I'm pretty excited about for development and finance platform for large scale decarbonization projects, such as clean fuels, synthetic graphite, carbon capture, et cetera. So we're working on a lot of things right now. Very honored to be a part of the panel today, David.
Thank you. So I want to come back with a much more specific question. So I want you each to tie who you are and in the space you're in, because as people were listening, we have 5 very different people. I'm generally deep tech and invention. Jane is in the biological sciences. We have enterprise software. We have James, I think, a variety of different deals, and then energy and natural resources. A very, very diverse, comprehensive set of alternative investment. If I were to summarize it, would you each talk again a few minutes, 3-4 minutes, on the role that private equity plays in the space that you are part of, and maybe a little bit how that role might be shifting because of the environment we're in, and talk a little bit about the environment. So I want to tie it back to the topic of the panel, which is private equity, and I'd love to run it in the other direction just to give the time in the other way. So we'll start with Jason, and maybe you could talk a little bit about the multiple that you see in the deals you're a part of, just a multiple over cash, to give it perspective for people who are looking at investment. There's a theme I want to run here, which is the difference between what's going on with your relationship with private equity and how a family office is going to play or not play in that space. So you can talk to that too.
Yeah, thanks, David. So, prior to launching JT Wallace Investments, I've spent the last three years doing private deals kind of on the side, in addition to kind of helping our private equity firm at VP Capital raise some money. Really what we're seeing right now is, part of my network is family offices, and especially the bigger family offices who can go direct, who has the investment teams to kind of do direct deals as opposed to through sponsor funds. And then the other part of my investor network is the PE and the VC funds, and then larger institutional kind of sovereign wealth funds, et cetera. So, really in my space, what we're seeing is the specific to family offices, there's only really a subset of family offices who feel like they can go to direct as opposed to through, sponsor PE firms. Now, the asterisk there would be if a family office was, launched by the principal that made a bunch of money in manufacturing, maybe that family office is still comfortable kind of doing direct deals in manufacturing. But otherwise, they're going to go through, sponsor PE firms. So, I mean, look, prior to the pandemic, you certainly saw, a ton of activity. There's, it's been well noted that private equity is sitting on a bunch of committed cash. I think there's a very big differentiation between committed cash and called. But, I've talked to a lot of the larger private equity groups over the last, several months. I mean, 50, 60 of them. It certainly, there was a demarcation made at the beginning of this pandemic, and there's just less deals getting done. The bid-ask spread between buyers and sellers is still largely there. I would say again the subset of that is not included are more digital and streaming and kind of the Amazons of the world who have done very well during the pandemic. But otherwise,
so I want to pause you right there. So what you're saying is there's a repricing of value, and that's increased the bid-ask spread in deal flow, and deal flow is down. Is that right?
Roughly so. So, I think by and large, and again, we're seeing a little bit more deal flow in the last few weeks, but by and large, what's happened during the pandemic is when kind of asset prices fell out before monetary and fiscal stimulus kind of fully kicked in, you've basically seen sellers that want to sell at multiples that were prior to the pandemic. And I'll say they want to sell on EBITDA, right? Earnings before interest, taxes, amortization, depreciation, and coronavirus, right? So the sellers want to sell at EBITDA, and the buyers are saying, no, this is not appropriate. We don't know what the future is going to look like, and so there's just a bid-ask spread between buyers and sellers, and that's why the deals have not really been getting done. A lot of people will point to the trillions of dollars that are sitting, in committed capital at the PE funds, but most of the PE funds are still looking at their current portfolio companies and wanting to make sure that they have cash and can recap those companies as opposed to putting new money at work. Again, it's changing a little bit in the last few weeks, and the kind of the companies and the industries and the verticals that have done well during the pandemic are a different story.
Thank you. I'm going to pause you right there. So I heard a second theme, which is conservation of dry powder to make sure it's available for investments that have already gone on out of this fund. So you have a gap in pricing, and you have a conservancy around protecting existing assets and investments. It's one of the themes I picked out of you. I'm going to come back to James. I'm sorry for trampling on you earlier.
Well, one of the things that we should also talk about is, besides the fact that, there's a little bit uptick in deals, but basically the deals that we're still working through the first quarter, those that did close in the second quarter, maybe they've been pulled. It's this uncertainty of the future, especially in middle market focused transaction. And I agree with Jason, it's excluding the technology companies that have been doing well during this. But the typical companies, distribution, manufacturing, whatever it might be that can use leverage, it's those deals that are suffering, very similar to 2008, 2009. We're seeing similarities, except the banks are healthy this time now, and we haven't had a consumer cash crunch yet, which we might. But what we're trying to figure out is, what is going to be the formula that's going to get that bid-ask spread to sort of narrow and get a transaction done? And the formula is going to be obviously some sort of earn-out, some sort of escrow, something that people can sort of live with. Hopefully the simpler the better. But even when that gets sort of accomplished, you're going to have a lot of trust that, we're not in a start-stop economy where we start for 3 months and then we stop again, and then all these numbers sort of go away. And then we don't know what the long-term damage is on middle market companies. And we think of middle market companies, I'm thinking companies less than $300 million in revenues that don't really have the legs to sort of get through 6 months or another year of hard times. So in this world, you need to really be doing your due diligence. This whole sort of story that we're going to do due diligence, the private equity said, without ever meeting anyone, that is complete bullshit. There's no way that anyone should invest one dime without understanding the management, especially right. You got to know what's going on. You're going to have to take a much deeper dive. You're going to need expertise on the trends of the industry, and you're going to have to try and separate yourself to go get that deal, because you can't just sort of go through a competition. And if it gets run up and overpaid because someone needs to allocate money, then it's going to be a bad deal from day one. And we obviously don't want to be part of those type of deals.
In our earlier conversation, you talked about numbers in terms of deal flow dropping from 50 to like 5. Would you still characterize it as that?
I would say the real deals that are moving around in the New York City's tri-state area is probably 20% of what it should be. I would say that's the big drop off. I think everyone's giving statistics that are merging in, first quarter and second quarter, then they're sort of skewing the numbers. But if you looked at what's really could be doable, there's probably, out of 100, there's probably 20 companies that are doing okay, that could be sold, that have good reasons. Maybe we can get 3 turns of leverage on them, maybe. Maybe they have to be bridged with all cash and then refinanced. That's it. And we need some sort of catalyst. And maybe a window opens, I'm hearing, in the middle of September, and a few companies try to make a mad dash to get a deal done by the end of the year. But the process is going to have to be very different than normal. And I'm being optimistic, because we could see, what we don't want to see is we can see some sort of contagion where you have companies that are being pulled because they're deteriorating so quickly. Now, again, if it's a sponsor, they're going to be smart enough to put money in there and not bring it to market if it's damaged. But if it's a really nice family-run company or entrepreneurs that were sort of on that path that want to test the markets, you're going to really have to understand what you're getting into to conclude a transaction. And that size is not just small. I mean, that's probably a $500 million sales company, I think.
Thank you. So what I'm hearing there is a clear bifurcation between tech capable and virtual and COVID resistant buys and the rest of the market, which is the majority, for which there's a sizable slowdown in deal flow and increased responsibility due diligence. Just to summarize it simply. Let's go back to Christian, because I'm imagining in your universe that you're gonna see a mix of opportunity. That now you're talking about electronics and digital and software. Do you see it as a down market, up market, more deal flow, less deal flow?
Yeah, so just to kind of qualify, enterprise software, for those of you guys that are on the phone that may not be familiar with that term, refers to software that is sold typically to businesses, right? So it's business to business. Specifically, we focus in on the lower middle market, so nothing pre-revenue, but companies that are between typically 5 to 20 million of revenue, which is before the typical private equity feeding frenzy of interested private equity companies that look at things with 3 to 5 million of EBITDA. But to answer your question, the deal flow actually has increased dramatically, and it's really a tale of two cities. The first is that you have these distressed enterprise software assets that quite frankly are going for 20 to 30 cents on the dollar. So typically the valuations that we're seeing now are 1 to 2 times revenue, but they have to be distressed, meaning that they are more than likely losing money, and either their creditors are forcing them, they're no longer looking the other way from a covenant violation basis, and so therefore are going through workout scenarios, or the equity holders, the larger equity holders are basically taking their chips off the table, off of smaller assets in the lower middle market, and redeploying those chips into bigger assets that they believe have longer wherewithal. Or you quite frankly have owners that were running the business as a lifestyle business and effectively have run into either personal or business liquidity issues. And so that has forced a situation where you have really great companies now online that are actually growing, sometimes 20 to 40%, but because they're unprofitable because of these situations, they are forced to sell for 1 to 2 times revenue. And enterprise software is very, very sticky, and so it's not something that typically the customer base goes away. But I say a tale of two cities because at the same time you have a lot of this increased distressed deal flow, and quite frankly it's quite overwhelming right now with all these deals coming out of the woodwork. But for the companies that are performing well, that are growing in revenue, that are profitable, they have more work coming out of these Fortune 500 companies than we've seen in the past. There are specific segments within enterprise software that do extremely well because these Fortune 500 companies have to figure out how to provide the same service with less people, and in this particular case, less people and a remote workforce, which caught a lot of these Fortune 500 companies by surprise. And so the valuations for well-run enterprise software companies, even in the lower middle market, is typically between 3 and 8 times revenue, with the average being around 5, with private equity companies typically paying between 3 to 5. And then, you've got strategics, the big software groups like IBM, Salesforce.com, and so forth, that'll pay 5 times plus, sometimes even in
so we've
double
shifted
digits.
terms a little bit. Now you're talking about revenue. You're not talking about EBITDA. So
No, it's all revenue.
So we're talking 10 to 20 times EBITDA, I imagine.
Oh yeah, definitely. And again, the reason why that is because once you're in like a JP Morgan or an AT&T, that technology is not going anywhere unless you're an Oracle and you quadruple the price. That technology is not going anywhere, and it's there for the long haul. And so you've got a lot of sticky technology that you can effectively run rate if the worst case scenario occurs to drive a lot of EBITDA at the bottom line. So you're rewarded earlier on in the process for revenue and not so much EBITDA. In fact, a lot of I don't necessarily subscribe to this philosophy, but you've got a lot of situations where companies will sacrifice all their EBITDA and then some to effectively try to grow faster than usual. The issue though is that when you get into situations like what we have today, where the credit markets have seized up, and banks are no longer looking the other way from a covenant violation, you can get yourself into a lot of trouble. So it doesn't, we don't necessarily prescribe to that, approach, growth at any cost, by any stretch of the imagination. But yeah, deal flow is really great right now, and the multiples are good.
So thank you. So, again, interesting contrast. The economy has winners and losers. The software business being directly addressing the change in workflow and the change in work status and productivity is showing, higher valuations, the way I see it, as opposed to traditional manufacturing and other sectors that James was talking about. Jane, back to you. Can you talk a little bit about where you see opportunities and engagement with private equity and what those deals are about? Because I imagine biological and life sciences is also pretty hot.
Well, it was really hot. Before COVID, we had, traditionally the private equity VC family offices were earlier stage, smaller companies, smaller investments. For earlier companies, ones that were later on in development, further along in what we call the clinical trial pipeline, they were de-risked to a certain extent, and big pharma felt that they could, gobble them up and bring them in-house. And pharma was really looking at these companies and acquiring them very rapidly because they had fallen off the patent cliff. And they were looking for new opportunities. Cell therapy and biologics was an area they were highly interested in.
So this is an intellectual capital purchase flow. So
correct.
Find deal flow, find invention, have larger companies step in to commercialize.
That's
Typical
right.
Deal flow. Okay.
That's right. So they were going earlier and earlier, and they were pushing the VC private equity family office back further because they were investing in early and earlier deals because they felt that this was such a hot growing market. So we found that the private equity VC firms were competing with big pharma for the same type of deals. Now that COVID has happened, the deal flow has been reduced precipitously. Many of these early stage companies do not know if they're going to have a continuation of funds, whether it happens to be a VC private equity or a family office or pharma investment. So they're scrambling. They really don't know where their next dollar is coming from. They're pivoting to go towards COVID technology to develop vaccines for the disease or treatments for the disease. That meaning organs that are failing, they're developing new technologies for that kind of thing, for lungs, ARDS, all of that. Well, that's a short-term solution. And as we go forward past COVID, we're going to see a readjustment of all of that. And we have to start to think about not only the treatment for the disease. That's a really expensive thing. That technology for treatment involves FDA approval. It's a long series of funding. It's millions of dollars to get it through the FDA to approval for commercialization. But there's
Dave,
other
can you hear
things
me?
around it.
Dave?
Yeah.
Jane? So
Yeah.
a quick question I have, especially with regards to COVID, because we've had a lot of healthcare people speaking since April. And can you talk about winners and losers? Because it seems like a lot of grant money has become available.
Yeah.
And so we've had firms that were looking for $60 million and they said, oh, sorry, we only need $10 million because we just got a $50 million grant. So can you talk a little bit about winners and losers? Because it seems like there's a lot of COVID winners, and then maybe there's some healthcare IT winners who can, deliver in the, telemedicine space. Seems like those guys have been winning. And then it seems like the people you were talking about, people who were looking for venture capital money or private equity money, but weren't necessarily in the right space, are kind of out there starving right now. Maybe you can talk to the winners and losers. Thanks.
Sure.
And also we talked briefly about the supply chain play as well.
Yes.
So you have the entire medical base and supply issues as well. So you have,
Right.
Yep.
Right. So there's warp speed that President Trump put out as a funding mechanism to bring cures, vaccines to market as quickly as possible. It was a combination of NIH and BARDA funding, and it was to the tune of billions and billions of dollars. And it seemed to be targeted funds. because we were trying to find out where we could even apply for those funds to support some of our companies. And it was very elusive. There was no way to really find a portal to apply for those kinds of funds. So those, I think, were some pre-targeted funds. And so we have some winners there, some of the large pharmaceutical companies that I think have an advantage in that regards. Some smaller companies have been able to get BARDA funding. And so that's been wonderful. And so they're able to develop those vaccines to a further stage of development. The first wave of vaccines will have a certain level of efficacy that won't be as high as the later phase, the next wave. You're going to have to get the best you can in the shortest period of time. And then after that will be a next wave of vaccines. We'll have to also adjust to how the virus itself is mutating. So there are some winners. There are also some startups that have been able to take cell therapies and direct them towards reducing the inflammatory response in the lungs. So to address the ARDS, which is killing people. And then there's some things that, along with liver damage, that is killing people. The organs are basically shutting down. And there's a number of reasons for that I won't get into. Now, if we look at the IT component of this, the IT component is very interesting. You want to track patients once they've been treated with a vaccine or anything, cell therapy or anything. And tracking is becoming a hot button, whether it's tracking people that have tested positive for COVID, or whether it's tracking people after they've been given a vaccine, or tracking people after they've been given a drug to cure disease. So I think that is something that is being developed extensively. Artificial intelligence is being used in many different ways now, and I think COVID and the use of technology is going to push the use of artificial intelligence forward. I'm still unclear as to how that artificial intelligence is actually going to be used in a useful way to cure patients. And there's many nodes of opportunity in artificial intelligence, tracking patients, identifying people that are more likely to get ill, identifying the treatments that will be most successful with artificial intelligence based on prior research and historical data. So there's a whole number of different opportunities. We could talk for an hour about that.
But we're not going to talk for an hour. So,
no.
So what I want to do is so I think that it's interesting because I think from artificial intelligence, there's machine data and there's data collection. But so maybe we can talk about, because this has been a big concern with our audience, is it time to really look at, these riskier distress plays, or should we still be waiting? And maybe James, you can, talk to that a little bit, and Christian as well, about, where you see distressed at this point in time, and then also the role of leverage in all this. Because I mean, when you're talking private equity, you're talking about there's leverage available, and I think David has said there's a leverage pullback. So when do you think that pullback is going to come back? When do you think it's going to go the other way? So can you guys address that and start talking about that as well? Thanks.
So put on your family office hat. How do you leverage PE? Where are the deals?
Where are the deals, and whether the time is right, or whether we should be waiting 6 months out in the calendar? And I think James is a great, excellent person, and of course, Christian, you're great at this as well, knowing on timing of execution. So
I'll just exclude the technology side to it because it has its own life to it, and we'll exclude, the pharma side to it also. But more of the traditional acquisitions, I would say, get as close a look right now at the companies just to determine early on if you should invest. So I don't think it's a waiting. I think you got to look at everything that you can get a hold of. But if you do like it, I think that there's an opportunity because there's more problems which are coming down the road to try and get an early bid into a process and maybe scuttle it, which would be interesting to sort of look at from that angle. So if things are coming in the fall and they're just sort of hitting the market, or you're hearing about it and you feel that, this is something you're interested over the long term, you're probably better to sort of get in there earlier. The longer that company stays on the market, if the deal doesn't go through, the more risk you guys are going to have, because either the company is deteriorating or the process is going to cause the price to go up artificially, and now you're just in a bidding war and you just got priced out of it. So I think earlier is better. If the deal gets pulled, you'll be right there, hopefully with a relationship to go back in when the company's healthier.
Yeah, and you know, speaking specifically in the enterprise software space, there are 9 segments within the enterprise software market that we believe are, I won't necessarily say recession proof, but recession resistant. And we've back tested this with Gartner and IDC. Specific enterprise software segments like automation, collaboration, security, they were called things differently back in the dot-com implosion and the Great Recession, you know, but effectively it's the same type of technology that underpins, you know, these types of companies. And so we see a lot of great deals right now in these segments that, quite frankly, are growing between 20 and 40%, and they have more customer demand than they know what to do with. Again, just quite frankly, because you have these Fortune 500 companies that are looking for increased efficiency to deliver the same service and also a remote workforce. And so, you know, where these opportunities are, we believe are in these 9 segments. And you know, these are arenas where if there's a distressed enterprise software company within that segment, quite frankly, you can buy it for, you know, like I said, 1 to 2 times revenue. And in most cases, what we're seeing right now, which was unusual since you know, this is the first recession that our private equity platform has been around, is that usually when we look at enterprise software companies, they're usually flat in revenues or decreasing, and they're certainly unprofitable. In this particular case, you have companies that are growing between 20 and 40% year over year, but are unprofitable and in this pinch to effectively sell because of the prior situations that talked about. And so if you look at, you know, if you kind of model this out without leverage, you can basically come in, buy these companies, and effectively just based on the momentum that they have from a revenue basis, they'll pay for their own acquisitions over the next 3 to 5 years. And from a leverage basis, you know, there's not anyone that's going to necessarily give, you know, a distressed enterprise software company leverage at this particular moment in time, just because the credit market is pretty frozen up. But I think, you know, as a company gets turned around and does start to perform and can keep up with that 20 to 40% growth and be profitable, you know, you're going to see, you know, a lot of, you know, dividend recap opportunities in the, you know, in I would say the next couple of years, you know, down the road. But they have to be well performing, and they have to be in these recession resistant segments. That's my 2 cents on that.
Jason, do you have a comment?
Yeah, I mean, I would say, look, over the last 10 years with this bull market, you know, the buyers of direct deals or of companies or assets have by and large been private equity sponsors and strategic. The family offices, even the multi-billion-dollar family offices that I do business with and talk to, they just can't compete with the strategics and the private equity in a bull market that's kind of up and to the right. But in a recession, in a pullback, that changes, right? So a lot of the family offices can be more competitive in terms of the valuation and the prices that they can transact with in more of a recession. So a lot of the larger family offices I talk to have been kind of sitting on the sidelines, just waiting for this season. And as we've talked about before, a couple of panelists already, there's really a binary, you know, economy that's happening right now, and the enterprise, you know, software, for example, that Christian speaks about, the streaming, some of the other COVID solutions that Jane was mentioning, and healthcare are doing well, and you know, the family offices by and large are probably not going to be able to compete with those, with some of the exceptions that Christian gave. But then you have this whole other part of the economy that's more kind of brick and mortar, industrials, manufacturing, logistics, that really there's still a question of, when we fully come out of this pandemic, is life going to look different? Are people going to stay home more? Are people not going to want to have office spaces and work from home? You know, and so there's big question mark over the forward-looking kind of forecasts and growth projections for these companies. And so while I do agree with James that if you're a family office and you want to be investing in direct deals, you should absolutely get involved now with the great, banks such as James Bank or others to assess deals. But really, for those companies where there's a question mark on the future in terms of demand, I would just say tread lightly and really do your homework because life might look different, even if we kind of quote unquote get back to normal.
So I'm hearing there's a differentiator there in terms of the quality or your ability to do due diligence on an uncertain future in a certain segment. So if you sit as a family office with knowledge in a particular segment, whatever your family office is expert in, you've accumulated knowledge somewhere, that may be the opportunity to go into your segment and find distressed assets or uncertain assets at a decent price, because the buying frenzy from private equity is down. That's the way I hear it. So I'm fusing what I've just heard from the last three of you. So per James' advice, if you're able to do due diligence and you have a unique position in that particular segment or that market or that knowledge base, this is an opportunity to play early and get involved with assets which are available ahead of what is normally again, James was anticipating is going to be a few deals bid by a lot of people. If you are unable to perform that due diligence and understand the market because of the uncertainty, I'm hearing from Jason, tread cautiously. Is that too much of a reduction? Anybody have a comment on that?
My only kind of additional comment would just be that, look, in some of these industries, we just don't know if we're going into a prolonged kind of recession or pullback. And again, for most of these owners of these companies, they're just not willing to sell at distressed prices yet, and or the buyers are just not willing to give them the prices that the sellers think should happen. So I just think there's enough uncertainty with the future of some of these kind of, again, kind of hammered industries to really find a price that clears the market.
So is there sort of an Arkansas answer here, which is take a look at the fundamentals of the business, take a look at their cash flow, look at the position they're in. They're looking at it very carefully, or they see the future coming. Is that a chance to actually participate? If you have cash, there's a bunch of companies that need cash. This is the opportunity to, form ranks and do a deal.
Well, I think what Jason is saying is exactly right, but the answer is what some private equity funds are doing. They have formed very quickly little minority, non-control investment pools to get their foot in the door with a lot of options to get control down the road, which is exactly what these beaten down industries, or assume they are going to need. They need bridge capital really badly, and they don't want to sell, but this is the only thing that they can sort of rationalize, or they're going to get liquidated by their lenders. That's another thing that no one's talking about. The lenders don't want to be in the same position they were years ago. So they're going to they've given as much as they can. But I was just talking to someone who got thrown into workout really fast that didn't think it was going to happen. And their basic plan is if they can't come up with third-party capital, they're just going to start shrinking their availability. And, if for a company that actually would do well, if they can get a lifeline from a family office that understands what they need, there's a lot of ways to structure something and get a company that won't then go into the market with a feeding frenzy, where they can then buy control of it in a year or two when things are rational. But
we have a couple of minutes left, so I just wanted to address a couple of questions here. But maybe you guys can give 20 seconds each to talk about whether the PE firms in your sector are buying or waiting, and also talk about whether or not the people who are looking for capital right now, whether the companies are distressed or the owners are distressed, and which ones you're seeing more of. And again, brief answers would be great. So why don't we start with Jane, and then we'll just go right across with everybody, Christian, James, et cetera, Jason.
Where people are still active in buying are in areas of the support industries or that support sciences. So no matter what happens, core technology, all the supports like artificial intelligence, source material management, procurement, assay and test development for testing cells, those are all still good investments. People are looking at those very carefully. Just wanted to make that clear as we move forward.
Great. Okay. And are most people, you're seeing a lot of distressed companies or distressed owners?
I'm seeing some of both. Distressed companies, and I know quite a few distressed owners, but usually it's the company first, right?
Not sure. Christian?
Yeah, so I would say that right now, there's definitely a lot of, there's not a lot of buying going on right now, but I think that there's a tremendous amount of opportunity, for sure. And right now there's a lot of, especially as you get out of the lower middle market into the middle market and the larger companies that are 50 million plus of revenue, you have a lot of scenarios where, there's a lot of patient capital that's been backing these enterprise software companies. And in terms of the owners or the companies, definitely seeing both, but I would say is that, especially in the lower middle market, you have more owners that are in distress because they've leaned upon their companies and leveraged their companies to run their businesses as lifestyle businesses. And so, they have typically taken a huge balance sheet hit personally, and that's definitely one of the main reasons why we're seeing all this increased deal flow. But yeah.
So personal motivation to make a transaction.
Yep.
So Christian, for your side, it's not wait and see.
No, definitely not. There's definitely a lot of value, and you have to remember in the enterprise software space, the end customer, will sign up a subscription deal for, it's kind of like your iPhone, right? Where you pay $1.99, although think of it more like, paying $100,000 a month, but those contracts are for 3 years, and they have automatic measuring capabilities that are done quarterly. So, it's very, very sticky. The technology is not going anywhere for a JPMC. It costs them more money to rip it out and replace it than it does to just continue on with the status quo.
Great. Okay. So James, sorry about that.
Our clients, they're fine. I don't really know enough about the actual owners or the private equity funds. You find them more patient capital, but they almost want to get approached for some sort of solution. So maybe that's where there's sort of, one-off deals where, that they're not doing well and they can use capital. But I think that, you also have a lot of CEOs and middle market companies that are a little bit in denial because they have PPP money and they've sort of put a Band-Aid on their problem. And they're hoping that they're going to open like tomorrow. And there's not a lot of plans right now. I can get them for another month. And then people are sort of throwing around Main Street capital. I'm not sure if that's going to happen properly. So I think we're in a little bit of wait and see for maybe another 6 weeks. But it's not. It's definitely these companies. They just need a life.
And I'll tell you a funny story. It's not private equity related. It's real estate related. But most people in Texas know about Plano, Texas, and how they've been building out the whole, Dallas Cowboys practice facility, et cetera. And there was a real estate investor, developer from Atlanta, who had taken out about $700 million in debt to make some buildings, and he kind of had a shortfalling, and he was on default on his debt, and he was trying to find some funding. And we went back to a bunch of Atlanta guys, and the Atlanta guys said, well, why should we help him out now when he defaults? We're going to buy this stuff for 10 cents on the dollar, right? And maybe that's the wait and see that people in private equity are waiting for as well. James?
I would say that's definitely an option. I think they're hoping. I think some middle market private equity funds were hoping that there was more decent distressed companies. Our word decent means financial solutions for them, and they haven't really seen enough yet. We haven't seen. Again, I think things are rumbling, but I would have liked to have seen by now, a couple hundred good companies that just need money and they're out there in the marketplace, and I know they're suffering, but I haven't seen them, come to the market yet.
So I'd like to respond, Marty, to you, what you're saying. So there's a difference between an asset that's going to sit there and an operating company that needs ongoing cash to preserve its value. So if you wait and see on something that dies when you don't provide it cash, that's not a good idea. If you can wait and see on something that preserves its value.
No doubt about that. What I'm saying is that in lower middle market private equity, there are owners who have stayed in the market longer than they wanted to stay in the market, or who thought, good times are going to keep on rolling in 2020 from 2019. And now they're like, hey, I'm near retirement, or I should have retired 10 years ago, and maybe I want to get out, right? And that's where distressed owners come in, where people just say, hey, you know, I'm a boomer. I should be retired and living in Texas or Arizona right now, rather than doing, you know, trying to make miracles happen in Minneapolis, right?
Yeah.
So, Jason, any comments? And by the way, Scott Leonard, are you on? Are you going to start up soon, Jason?
Yeah, I think my parting comment would just be like, I think there's always opportunities to get a good look at good deals. And I think the other panelists have expressed that now. I think as a family office, I would want to partner with one of these guys to make sure that you're doing it in a thoughtful way. You know, look, I think that everyone in the distressed world, all my distressed fund kind of guys that I know, we're just hoping that the monetary and fiscal stimulus massive wave didn't hit like it did and kind of bail out a lot of companies that otherwise would have been great distressed opportunities. I think it just prolongs it. But again, I think you really got to do your homework, because the question is whether or not the future looks like, you know, a pre-COVID world.
Perfect, great. Well, listen so much, guys. Thank you very much. You've done a great job. And, you know, we had a little bit of confusion because Scott Leonard had not replied to answer mine, but Scott's on to speak about a SPAC. And SPACs are incredibly hot right now. I think there's a hedge fund manager